RBL Bank, we thought we'll chat with them post policy last week as RBI has hiked rates, getting a growth strategy perspective for FY19. So let's bring on board Rajeev Ahuja, the ED at RBL Bank. He joins us on the show right now. Rajeev, FY18 has been a fairly good one and we did see asset quality improve for you in the fourth quarter. Would we see even better FY19 results going forward?
Yeah, I think we maintain our guidance. I think overall our platform, our franchise in all our segments has continued strengthening. I think some challenges of demonetization on some of the portfolios are pretty much behind us. Our scale, our presence in the market, our brand recall across the spectrum has improved. So as growth comes back, and we think FY19 is a strong growth here at both the corporate and the retail level, plus you have monsoons which look like going to be very positive. We see a very positive year and I think our guidance has been pretty much along the same lines that we will continue growing and we'll continue building our operating leverage and our profitability.
Rajeev, banks have already begun hiking MCLR. With the interest rate cycle also moving up now with the RBI hiking rates by 25 bips, how much is it that you see your cost of funds rising?
Yeah, so I think this hike was pretty much presaged for 5 months. I think we all expected that rate cycle will move. There's lots of good reasons why they should move: inflation, oil, growth, global rates. So that was pretty much baked into our thinking. So if you've seen deposit rates as well as MCLRs have been inching up over the last 2-3 months. So yesterday's hike by the RBI is just a validation of the trend the market has been witnessing. We do think there's probably a room for another hike of 25 basis points sometime in this calendar year, just to kind of take care of growth dynamics, any incipient inflation, etc. I think we are quite well positioned. The way we run our business, we kind of look at a core and then the mix of business, improving CASA. All of these will help us maintain the trajectory we saw in Q4. In fact, in our annual commentary, we were quite explicit saying that we would be able to maintain or better our NIMs from 4%. In spite of a little bit of a cost push. So I think you'll see that. And as the cost of funds and the MCLR channel starts sorting itself out in the next 3-4 months, I think the mix of business and CASA improvement should keep helping us.
Right. Speaking about the growth, how do you see the segment mix between MFI, corporate banking, agri, commercial, SME going up or shaping up actually into the future? And overall, how confident are you of and over 25% loan book growth?
Yeah, so if you see last year we've grown 37% overall balance sheet and it's been a very healthy mix. Our wholesale business has grown 32, 33. Our retail and rural have grown between 40 and 50 odd percent. I think we can maintain a trajectory of overall growth of 30 to 35%, which has been our guidance in the medium term. I think we're quite positive that those things will be maintained. Our platforms are in good shape. There's growth obviously coming back. Corporate sector is also, needing more credit. So don't see an issue in terms of maintaining our guidance for growth, which we had given almost 2 years ago.
We've also seen a strong deposit growth of over 25%. How do you see deposit franchise move ahead? The traction that you see in CASA, and what is the kind of savings rate that you will target?
Yeah, so I think if you see the deposit franchise, it's kind of tracked the overall balance sheet growth rate, and the CASA has been growing higher than the overall balance sheet or deposit growth rate. I think we'll continue seeing that this year, and that's a reflection of us expanding our distribution, our technology-driven service channels, partnership services, overall retail growth. Our brand and time in the market is helping us. And as you keep building your retail franchise, there's a positive virtuous cycle which starts playing as long as you execute well. So we do think that on all counts we'll continue building it out, over this year and the next several years.
Right. But industry experts, see your market share shift from weak PSU banks to private banks. What is the kind of market share that you stand to gain, and any key states that you think you'd be targeting in branch expansion plans thereby?
Yeah, so I think this plays out differently, and we clearly are seeing some market share shift, which is also benefiting us. And that's been a little bit more pronounced in the wholesale client base on the loan side, as well as the non-funded side in wholesale clients. And I think the way to leverage that shift is to have a very strong CRM, relationship management, risk management, and a very active dialogue with customers. We're seeing many of our wholesale customers come out and look at a more broader set of services from us, which we are now able to provide. So you'll see that happen. I don't think you need to build a very large branch architecture for the wholesale business. On the retail, certainly, on the retail, both loan side and to a certain extent on the deposit, I think there will be a market share shift. It might be a little longer in terms of the customer inertia, especially on deposits. But for our franchise, we have enough in our scale, our platform, our different vectors to continue the growth and take advantage of the environment, which we believe is a positive environment for well-managed institutions with a high degree of focus on risk as well as customer service. So on all those counts, we think it's an attractive year for us. And as the base becomes larger and larger, you're able to leverage changes in market shift, changes in technology, changes in partnership a lot more.
So two-pronged question. A, would you be exploring any inorganic growth opportunities as an overall strategy? And B, then, what would be the capital raising plan for FY19 to 20?
Yeah, so I can give you a very easy answer for your first question. We do not need inorganic expansion. We have enough on our plate, enough organic growth potential to keep delivering and scaling up the franchise both from a shareholder and a customer perspective. So that's a straightforward answer. Second, I think we raised capital last August, which is sufficient for us at least for the next 7-8 quarters before we decide to raise the next round of equity. Our returns are improving, our leverage is improving, so all of those things are helping us. So I don't see, at least for another 7-8 quarters, us needing to raise another round of equity.
You know, the management recently shared guidance for Vision 2020, wherein we do see return ratios of about 1.5% by 2020 and strong advances growth. What will be the key drivers for improvement in return of assets?
Yeah, so actually if you see our tracking from the time we gave the guidance, if you see FY16 to FY18, we've improved our ROA by over 20 basis points. We closed FY18 at 121 for the entire year. We were under 1% for FY16. So pretty much tracking that guidance. And actually what happens is as the bank starts expanding and there's a wider set of customers, the distribution expands, the operating leverage starts working in all our businesses, right from wholesale, retail, rural, as well as the deposit franchise. So we're quite confident that we are on track. And for a bank of our size, we can continue maintaining that rhythm over the next 2-3 years to actually deliver the targets which we have set for ourselves and conveyed to the shareholders.
All right, Mr. Ahuja, we leave it at that. Thanks very much for joining us and giving us those details about your business and the plans that you may have for the future.